Hello dear professors, I want to introduce our project. Our project is part of the FinSight platform, an intelligent financial analytics system. This module focuses on pairs trading, aiming to combine traditional econometric models with modern machine learning for better risk adjustment performance. Pairs trading is based on the law of one price. If two assets are fundamentally linked, their prices should move together. Traditional econometric methods like correlation or integration work under linear assumptions, which often break down in real markets. We wanted to apply pattern recognition principles to financial time series data. Instead of only predicting prices, our goal is to recognize patterns of temporary mispricing, situations where the market deviates from equilibrium. Our main aim is to reproduce classical pairs trading strategies, extend them using machine learning, and evaluate their comparative performance. These results are visualized and deployed within the FinSight web platform for real-time exploration. We collected our 4 years of daily adjusted closing price for the SP100 constituents using the Y Finance API. This dataset covers large-cap, highly liquid stocks across multiple sectors, providing a solid foundation for identifying meaningful pairs. All data has been automatically adjusted for corporate actions and thoroughly cleaned to ensure reliability in subsequent analysis. Our FinSight pairs trading strategy contains two main stages. First is pair selection. In this stage, we will choose best pairs from our dataset. Next, we use this basic method and 4 machine learning methods. We will now introduce all of our methods. Our pair selection method is a novel 3-stage framework designed for efficiency and discovery. First, we use PCA to transform stocks into a set of core risk factors, giving us a unified scale to measure them. Second, we employ the optic clustering algorithm to automatically group stocks with similar risk profiles. This is powerful because we don't need to predefine sectors. The data reveals the natural groupings. Finally, within these clusters, we run precise statistical tests to filter for pairs that are truly co-integrated and mean reverting. This approach slashes computation time and data mining the market for non-obvious, profitable pairs that traditional method would miss. From an implementation perspective, our backend executes this strategy on real price data stored in PG Circle. We retrieve pair-level price series through a unified function, ensuring consistent preprocessing across all strategies. Trading signals are generated based on the parameterized state machine with entry, exit, and stop thresholds. Each trade is backtested to compute its profit and loss, accounting for transaction costs and hedge ratios. This modular design also allows us to integrate other strategies like copular and stochastic control within the same framework. In our project, the co-integration method is built upon the idea that some asset pairs share a long-term equilibrium relationship. When prices deviate from this equilibrium, we expect them to mean revert and creating statistical arbitrage opportunities. We estimate the hedge ratio gamma between the two long prices series using the EG regression and define the spread. This spread is standardized into a rolling z-score, which quantities how far current prices deviate from equilibrium. Whenever the z-score exceeds the predefined thresholds, the model opens or closes positions accordingly. The stochastic control method models the spread as a mean reverting OU process and the base assesses a GBM. An optimal position HT is derived to balance expected return and risk, adjusting dynamically with volatility and mean reversion strength. Unlike phase thresholds in the co-integration approach, OU-GBM parameters are estimated via maximum likelihood, and HT is stabilized through Tench capping, EMA smoothing, and volatility targeting. When the effective position cross entry or exit thresholds, trades are executed automatically. This approach produces smoother equity growth, lower drawdowns, and better adaptability to changing market conditions. The copular-based approach models the joint dependency between the assets separately from their individual distributions. We first fit marginal distributions, then estimate the copular function to capture nonlinear or tail dependencies. Finally, we use the conditional probability of joint tail events to generate trading signals. The base steps is listed as follows. Our machine learning method contains 3 stages. First is forecasting module. We use multi-deep learning models like TCN, transformer, and bits and hits to generate predictions for price ratio movement. Second, we use 3 distinct trading strategies to convert predictions into long-short signals with optional threshold filtering. Last, we trade execution with position sizing and market neutrality constraints. For forecasting machine learning model, to ensure a robust comparison, we designed a unified framework that integrates 4 distinct deep learning architectures. The TCN leverages dilated convolutions for superior long-range memory. The transformer uses self-attention to grasp the global context of series. Mbits is valued for being interpretable than composing patterns via residual stacking, and NHITS improves upon its multi-rate sampling for highly efficient hierarchical forecasts. To execute our machine learning forecast, we designed 3 distinct trading strategies. First, the reversion strategy acts as our classical baseline. It triggers a trade based solely on the last price move, betting on immediate mean reversion. Second, the pure forecasting strategy is fully AI driven. It trades directly on the model's prediction of the next price ratio movement. Last is hybrid strategy, which requires consensus. A trade only executes if both the machine learning prediction and the classical reversion signals agree on direction. This can effectively filter our noise. Finally, our threshold mechanism adds a crucial practical filter. It ignores signals where the predicted and reversion-based price move is too small, ensuring we only act when the potential profit justifies the transaction cost. Together, this creates a robust execution engine that translates machine learning prediction into actionable cost-aware trades. We employ and test 5 key financial metrics. CAGR measures our strategy smooth annualized growth rate. Annualized volatility quantifies its risks and the consistency of returns. The Sharpe ratio tells us how much excess return we generate per unit of risk taken. Maximum drawdown reveals the worst case historical loss from peak to through, a key indicator of downside risk. And finally, portfolio turnover estimates trading activity and the impact of transaction cost. The final selection compromises 4 trading pairs that demonstrate strong statistical properties for mean reversion strategies, and you can see our experiment environment settings below. The basic statistical methods show limit profitability and moderate stability, performing reasonably well but lacking adaptability to changing market conditions. In contrast, the machine learning method achieved much stronger and more consistent results. Among them, NHITS performs the best, delivering the most stable returns and highest risk-adjusted performance. Its hierarchical temporal structure captures complex patterns and adjusts effectively to short-term fluctuations. Overall, machine learning-based approach clearly outperforms traditional methods. demonstrating superior adaptability, smoother equity growth, and stronger robustness under real market dynamics. Our project successfully bridges classical statistical models and modern machine learning in one unified platform. Deep learning models, especially NHITS and TCN, consistently achieve higher returns and Sharpe ratio while maintaining low volatility. Beyond algorithmic research, our system delivers a completely workflow. From data ingestion to backtesting and visualization, it provides a reproducible and educational framework for financial research, leveraging NVIDIA vGPU 32GB for scalable computation. Looking ahead, our next steps will focus on refining model stability, enriching input features, and dynamic adaptation. That's all. Thank you.
Welcome to the FinSight, an intelligent web platform for financial analysis and strategy simulation. Our interface offers an end-to-end workflow from pair selection to trading performance visualization. And FinSight first reduced dimensionality using PCA and then applies optics clustering to group similar assets based on their risk profile. The system dynamically ranks and displays the best performing pairs. And now let's go directly to the trading analysis. Now we selected these 4 pairs. We use LLY UNP as an example. Here, FinSight supports both statistical method and machine learning forecasting models. Each method can be executed with customizable params such as z-score, threshold, and holding periods. Users can evaluate key metrics such as total return, Sharpe ratio, and drawdown, and visually inspected spread stability and profit growth. And there are 4 machine learning methods. These models forecast the future spread between stock pairs. FinSight automatically evaluates prediction accuracy using RMSE and MAPE metrics, and visualize predicted spread versus actual spread in an interactive chart. After running all these strategies, FinSight presents a unified performance comparison dashboard. Each strategy's annual return, volatility, Sharpe ratio, and maximum drawdown are summarized in a ranked table. The interface automatically highlights the best performing models, helping users identify the most suitable and profitable approach at a glance. Through FinSight's unified interface, users can select statistically justified pairs, run multiple trading strategies, and visualize results in real time. FinSight bridges classical economics with modern machine learning to deliver a complete, transparent financial research experience. That's all for our project. Thanks for watching.